So welcome everybody. It's good to see so many people that have joined, certainly at this late hour, to listen into and hopefully ask some questions about the enigma that is Europe. For many of you, this will be the second night in a row of extreme excitement following the football. So congratulations to England, firstly, who've now convincingly beat everybody in the tournament that they've played. Apart from Scotland, of course, who they failed to score even a single goal. But anyway, enough about football. Thank you very much for the introduction. Now, what I was going to talk about today, I don't want this to be a sales pitch. I wanted to talk about investing in Europe and what we believe. And I think there are three kind of core beliefs that we have that have helped shape the way that we invest and the shape of the portfolios. Now, as Dan mentioned, I'm one of the co-managers on our open-ended European fund, which we have had up and running since 1985. So we have a more than 30-year track record of investing in European equities. More recently, we also took over an investment trust, which is the Baillie Gifford European Growth Trust. And we took that over in 2019. And hopefully we're going to replicate the same types of performance over the next 5 and 10 and 36 years as we have in the open-ended fund. But going back to the core beliefs, what we're trying to do is construct portfolios, concentrated portfolios of between 30 and 60 companies. And we want to construct portfolios of what we consider the most entrepreneurial growth companies in Europe. And one of the beliefs that we have is that there's very much a hidden asymmetry in European markets. And this means that when we look at individual companies, we can see the asymmetry in the potential returns. So for us, the maximum, theoretically, you could lose in any one company is 100%, which is not normally a good thing, but the upside can be extreme. There is theoretically unlimited upside. So there are companies in Europe, and Europe produces just as many as any other region in terms of big winners. There are plenty of companies over the last 10, 20, 30 years in Europe that have produced these huge returns, 5x, 10x, 20x, 100x that you see in other regions. But to identify them and to invest in them, you need an unconventional approach. And to us, that means you have to be long-term. I know every fund manager, investment manager talks about being long-term, but you need to be genuinely long-term. And our investment horizon is between 5 and 10 years. We've held companies in some of our open-ended portfolios for 36 years since the date of inception. We've held companies like Adidas for 17 years, and companies like Mettler Toledo, which is a life science tools business, for 11 years. And both of these have been 10 baggers over the last 15 years or so. You need to embrace uncertainty. There is a lot of volatility in stock markets, but you need to embrace that and think optimistically about what might go right rather than what might go wrong. And if you get better at imagining these extreme outcomes and scenarios, it's more likely that you'll actually invest in companies that also deliver and generate these extreme outcomes. And I think to generate differentiated returns, you also need to have differentiated sources of information and insights. And we've worked very hard over the last 5 or 10 years to move away from the conventional approach of most managers and investors to rely quite heavily on sell-side research and the marketing information from companies. And we've built out a network of universities, academics, journalists, authors. We now sponsor most of the UK book festivals, and a lot of founders and entrepreneurs that help us generate this differentiation in terms of our ideas. The second belief we have, and I think Dan mentioned this as well, that Europe is certainly still overlooked and misunderstood. Europe, as I said, has done just as well as other regions at producing these outliers, these companies that produce these huge returns. But we think that over the next 10 years, Europe has started to reinvent itself, first through the smaller kind of companies and private markets, but this will then feed into the larger European equity market that most other investors have access to. But we also need to adapt. And both myself and the other co-presenter that you'll hear from later on, you've seen earlier on, have very strong track records over the last 5-10 years. But we need to adapt to ensure we have the best chance of producing those types of returns over the next 10 years. And for us, certainly with the investment trust, we now have the opportunity to invest in private companies. We can invest up to 10% of our total assets in private companies for our investment trust. And this is an area where Europe is certainly still playing catch up, but it's a place where we think that potentially we have an even greater edge in investing and finding ideas than we have in public equity investing. Now, we've spoken a lot about European outliers and asymmetry, and I think this graph hopefully kind of explains it a little bit better. So when we look at this European stock market, this is going back over the last 30 years, you can see the distribution of returns from all the individual companies. This is the return that produced over rolling 5-year periods. And as you can see, most companies over a 5-year period either kind of go bust or flatline. They don't really produce any value, so you don't lose or make any money in the investment, or go up to kind of 2x. And this is where a company will double in value, which generates a 15% return over 5 years, over a 5-year period. But what we're doing now is being much more proactive at looking at this right-hand shaded area here, this long tail of big winners. And when we look over the last 30 years, even if you were to pick companies at random, you would have had a 30% chance of finding a company that produced this 15% return per annum over a 5-year period. But what we want to do is focus more on these companies here. Roughly, you have a 5% chance of finding a company that will go up 5x over a 5-year period. And what we also have a much better understanding of, beyond the probabilities of this happening, are the characteristics that enable these companies to produce these huge returns. And that's typically faster revenue growth than the index and the benchmark. So typically, companies have grown consistently 7% or more over long periods of time. They've been able to expand margins, which have generated very quick earnings growth and cash flow growth. The majority of these companies also have inside ownership. So it could be a founder or a family or a management team that have skin in the game. They've invested a lot of their own money. And this provides them a much stronger sense of alignment, and kind of it's been shown that these types of ownership models work better. And also, we have more smaller and mid-cap companies producing these types of returns, certainly over the initial period, than we do from the large cap parts of the markets. And we can come back to this maybe in the Q&A, but maybe I'm biased, but I very strongly disagree with Dan in talking about kind of investing passively in indices, in trackers and index kind of vehicles that will give you exposure to a lot of bad companies as well, but maybe we can explain that a bit more later. But also something which Dan also mentioned was that Europe is starting to change. And certainly over the last 10 years, Europe has been held back by the composition of its index. And certainly over the last 10 years, the European index has been, probably in my view, clogged up with lots of these large cap, bureaucratic, slow-growing companies that haven't really produced any value. And we've also had a large banking and financial sector, which has arguably destroyed a lot of value for lots of investors. But things have started to change. The financial sector in Europe is now much smaller. It used to be 15 years ago about 30% of the index. It's now closer to 15%. So the composition of the index is starting to improve. But that hasn't really mattered because, as I said, Europe has still been pretty good at producing these big winners in areas like industrials, medtech, business services, and a lot of consumer brands. And a lot of luxury brands, which Europe really excels at in terms of producing. But what's starting to change now relates more to the technology ecosystem in Europe. And Europe's also always lagged, particularly the US and China, with producing technology companies that really understand how to scale up. But we can see that this is changing in terms of the number of billion-dollar tech companies, and this is both private and public, that have been created in Europe over the last 5 or 6 years. We're now starting as a region to produce a lot more of these innovative startups that have produced a lot of value. The funding environment in Europe is a lot better than it has been ever, and this is helping a lot of these startup companies kind of take advantage of that and take market share and develop what we consider these next generation tech champions. And I think this is then, at least backing up our belief that there's something of a re-emergence of Europe's ambition. Now, you have to go back to probably the late 90s, early 2000s to see some of the companies like Nokia, SAP, Ericsson, where Europe had a cluster of excellence and dominance in tech hardware. But we've definitely fallen behind in terms of producing asset-light digital platforms, the likes that you see in the US with Facebook and Google, and even in China. But again, that's starting to change. And a lot of these companies are now coming to the stock market in Europe and listed in the last 5 years. So we've got companies like Adyen, which listed a couple of years ago. We've got companies like, and Adyen's a digital payment processing business. We've got companies like Adevinta, which is a global online classifieds business. Now, everybody in the UK will understand and recognise Auto Trader or Gumtree, which it owns, or Rightmove, or these kind of general classifieds platforms where you can buy and sell goods. Now, Adevinta is now the largest collection of those classifieds in the world, and it has those Auto Trader type models in countries like France, Spain, Brazil, and no one's ever heard of it because it's a Norwegian company and it's just quietly getting along with its business, and it hasn't had a long track record in the stock market anyway. And obviously you get companies like Spotify, which is much more well known, but you can see how the composition or the exposure we've had to these types of asset-light digital platforms has increased as the opportunity set has changed. So looking at our investment trust, about a third of the portfolio is now exposed to these faster growing platforms that exhibit these network effects. I probably won't spend too much time talking about the portfolio. Maybe it's just enough to say that this is not just a technology portfolio. We do have about a third of the portfolio exposed to these faster growing, we call them digital platforms, but we also have exposure to some of the more traditional areas in Europe, particularly some of the industrial consolidators. And these are companies like IMCD, which is a specialty chemicals distributor. We've got global logistics companies like DSD and Kuehne+Nagel, and some of the companies which are producing energy efficient products like heat pumps or air conditioning and refrigeration, companies like BRF and Liebe. And not only do these companies produce some decent organic growth, these are companies which operate in very fragmented industries. So they can consolidate by acquiring smaller bolt-on companies and slotting them into their network. And then we've got some of the most innovative healthcare companies and consumer franchises in the world. Companies like Adidas and L'Oreal, and Kering, which owns Gucci, and Richemont, which owns Cartier. Now, these maybe don't grow as quickly, but they understand the changes in consumer behavior and they're adapting to this new digital environment much better than other companies. So as a collection, they all operate in very different segments and different markets, but they all have large growing markets to exploit. They have very strong competitive positions. Most of them have inside ownership, whether it's a founder or family, and they all importantly have a very good chance in our minds of producing at least a 2x return or 15% per annum return over the next 5 years. Now, what I also want to chat about is our exposure to private companies. And as a firm, we have been investing in private companies for about 10 years. First through Scottish Mortgage, who some of you, or many of you may know already and invest in. And we have over that time invested close to $5 billion US in some of these private companies, but we now have about 30 billion US invested in companies that we originally invested in when they were private. So over that kind of 9 or 10 years, we have created a lot of value. And what we've seen is that from a European standpoint, that we wanted to get involved with this. And this is why we were so fortunate to win the mandate for the investment trust that enables us to invest in private companies. Private companies in Europe are choosing to stay private longer. And a lot of the value which is being created by these private companies is not readily accessible by most individual investors or even most asset managers who focus primarily on public equities. So Spotify, for instance, as a firm, we invested in 2015 when it was still private. The value back then was about $8 billion US. It quadrupled in value from that point in 2015 to when it came to the public market, when IPO'd in 2018 at a value closer to $25 billion US. So it quadrupled in that period when it was private. Since being public, it's continued to create value, and it's now worth close to $50 billion US, which is a doubling. But unless you're able to tap into the period when these companies are still private, you're going to miss out, in our view, in a lot of value creation. This is why we're so excited to be involved in private investing now in Europe. And you can see some of the other investments that we've made as a firm, which have now, some have become listed, are now accessible. But some of these companies here, which I'll come back to, are still private. And we're very excited about their potential to create value while remaining private. And then at some point in the future, maybe when they're public listed. And I think for us, there are a lot of attractions of investing in private companies. And I, as I said at the start, think that potentially we could have a greater edge investing in private companies than we do in public companies. Because there's a network effect here, there's a flywheel whereby as we build up our network and relationships with private companies, when we collaborate and invest in these companies, we build a reputation as long-term crossover investors, meaning that we can invest both privately but help support these companies as they develop into public companies as well. And the more interactions with these companies we have, the better insights that we get, the more domain knowledge we collect on different industries and sectors. And this is kind of a flywheel. The more investment we do here, the more recommendations that we get. And access in the private market is very different to the public market. In the public market, you can go to a stockbroker or we can go to our dealers and just say, we want to buy these shares, just get on with it. In the public market, sorry, in the private market, it's very different. It's much more exclusive, and in many cases, these private companies get to choose who invest alongside them. And I think that that's where our reputation is now starting to create an advantage for us. And we can see that from some of the stats. 70% of the ideas that we've invested in across the firm in the private space have come from non-intermediated sources. So we don't have to rely on investment banks. These ideas are coming to us direct from companies who contact us, or we've reached out to speak to the companies themselves, or we've been recommended by an existing board member. And the quality of these ideas is much higher. And then the second manifestation of this kind of advantage is that when these companies go through funding rounds, it's not always the case that you get your full allocation, but because we are a preferred investor who have a very long-term investment horizon, who have been shown to be not only long-term but supportive, we typically get our full requested allocations almost 100% of the time. I think the stats about 90%. So we're in a very privileged position to invest in these private companies. And if I have time, I'll maybe spend just a couple of minutes. This is the last slide, just to show you the initial build-up of the private portfolio in our investment trust. And as I said, we've only been running this investment trust since the end of 2019. We made our first investment in the private space last year in 2020 into a company called Northvolt. Some of you may have heard of this. This was set up in 2016 by some ex-Tesla executives, and their mission is to build up Europe's leading sustainable battery manufacturer. So they're harnessing cheap hydroelectric power in Sweden, and they have a fully circular recycling model where not only are they going to be the cheapest, they're going to offer the greenest batteries to the European auto industry and a number of other industries. So this is something that, given the bottleneck from the supply of batteries, that Europe really needs. So this is going to be a European champion providing these batteries. And only it's a very short period of time, but when we invested in it last year, and I can disclose some figures, I can't disclose all of these figures, but when we invested in it last September, the implied valuation was about 4 billion. The implied valuation pre the recent funding round is 9 billion. So we've pretty much doubled our initial investment in less than a year. Now, as I said, that's far too short a time period to kind of gauge any kind of conclusion from, and it's just one company. But hopefully, this shows you the kind of the potential, at least, from investing in private companies. And we've also invested in 2 other companies. One being Sender, which is a digital freight forwarder. So this is using technology to remove a lot of the problems that involved or that exist in the road freight market in Europe. So there's a huge problem of inefficiency and a lack of trust between shippers. So any kind of enterprise shipper like Amazon, Zalando, L'Oreal, any of these companies which are trying to transport cargo, and the shippers or the truck companies themselves, of which there are tens, if not hundreds of thousands of. So this is a company which is using a digital first platform and software to solve a lot of these problems. And Flix Mobility is another company which is similar to this. And both Sender and Flix we've invested this year. Flix is the dominant European booking platform for buses and trains. And again, very asset light, but hoping to remove a lot of the problems that exist in mobility within Europe. So hopefully I've covered a few things there, but I think the message from us is that Europe's in a very good place. You need to have a very unconventional approach to give yourselves the best chance of identifying these outliers and to invest in them for long periods of time. And for those investors who are willing to look further forward, look over the next 5-10 years, and to appreciate some of the structural changes happening in the composition of the European market, it should be a very exciting and fruitful time for investors like that. So I've probably got run on my allotted 20 minutes, but hopefully that was of some interest, and I look forward to taking any questions you may have.